I think it could have been even a higher day this year had the CME group not shut down for 12 hours in the middle of the night Friday till Friday morning, claiming a overheating server, if you will, for the metals markets. Yet it's about you're talking the middle of the night. There's no volume going through the CME group or the COMEX. And you want to talk conspiracy theories? Yeah. So it's the only group that was shut down. Everything else was working just fine. And these server farms in Illinois, this one are built with double and triple redundancy. One air conditioner goes out, there's another two to back it up. But the CME precious metal server overheated, and that was, Friday was the day that the December contract went off the board. Delivery request. There was a massive delivery, something like $400 million worth of silver that stood for delivery and wouldn't take cash settlement. You have short positions. You have silver breaking out in Asia that night as it popped above $54, and the CME just happens to have a cooling failure in their servers for precious metals, but nothing else, not Forex, not interest rates, not equities, just in precious metals for 12 hours until it came back on. We're right at that level where things are starting to break because of delivery requests that used to be papered over and no one ever stood for delivery. That's not the case anymore. And so being naked short to a massive level, like some of these idiots is creating a very big problem. We saw it earlier in the year with the LBMA in London, where they said, no, it's not T plus 1 day, meaning trade plus 1 day the next day. The third day, the bars that you own should be moving your way or into your account. No, it's T plus 8 weeks. We're sorry, Jared, because there's a backup, a shortage of manpower and trucks in London. The Bank of England can't get enough in the way of trucks. So it's T plus 8 weeks for those bars that you were anticipating in 3 days. We're sorry. We're seeing it happen. And now it's happening here, right as the United States government makes silver a critical mineral, reclassifying it a critical mineral, putting a floor underneath it, a policy, a national security floor, right as it's breaking out across the globe, breaking through its 45-year cup and handle, breaking through all resistance, breaking through price levels in China before it opens in the United States. And although everything you can think of screams of Fugazi. So yeah, I think it will only go higher from here.
But then today we started to see it swing back up for silver. It seems like it's really hard for them to keep it down, even if they want to.
Yeah, well, that's physical demand overwhelming the paper shenanigans. With silver, it could be short covering, where they knock it down coming into New York. It was down almost $1, and then bang, it comes right back up after they cover their positions. Who knows what it is that does it? But nonetheless, you're right. In years past, that they would step on its neck and then cripple it. It wouldn't come back. Now it does, whether it be right away, like we saw today, or over a period of days. When silver went up for 9 straight weeks, no one complained. And then for a week or two, it got beat up. It fell below 50. Everyone said it's over. It's never going to sell your silver. Sell it. It's a joke. It was right back up to 58. The market wants to take as few people along for the ride as possible, Jared. And I think that you have to have strong fingertips sometimes. That's why so few people succeed in investing. That's why there's a whole school of investing ideology called wave theory, Kondratiev and Elliott wave, that speak to human emotions drive the markets. And people got very emotional when the market moved down over a period of a week or two, but not a word out of them and when it went up for 9 straight weeks. So emotions can get the better of people.
Do you have any take on what may happen with interest rates in December from the Fed? And, how do you think that's going to affect gold and silver prices?
I think they have but no choice to continue to do it. The problems in the repo market, the problems with the labor market, they have no choice. They'll lower rates again. And if you think about it, they're at the best they've gotten is 50% away from their target. That's not real accurate when you're 50% away. So trying to throw a ball 100 yards, you make it to the 50-yard line. Not going to work probably for your Hail Mary. Not to say anyone can throw it 100 yards, but you got my point. So, and not yet they're giving into inflation. They're giving up on inflation, giving into the economy at a period of time when they're not even 50% away from their target. And the that they use is all messed up. The CPI issued by the BS, the BLS, where they exclude food, energy, and housing and continually pull things out that are inflating like coffee and substitute it with tea, because surely no one would buy coffee if the price was going that high. These are the types of hedonics that they use to fit their inflationary agenda. The real level of inflation is 11%, according to Shadow Stats, which just measures it based upon the way it used to be under previous administrations like Carter and Reagan before it was completely changed. And so, inflation is much higher than we're told, and they're going to give in to it through lowering rates, through quantitative easing, through the reduction or end of quantitative tightening. They won't continue to sell assets off their balance sheet. It's not good. And you can expect a weakening dollar. They say the dollar is only down 9% this year against a basket of crap currencies, that being the dollar index. But look at it against gold or silver or platinum.
Yep.
It's down 70+% against platinum and gold and almost 100% against silver. So what is the reality? Is the dollar down 10% or 80 or 90%? It's down against gold, silver, and platinum. Real measuring sticks, I would say gold being the best, almost 75% this year. Look at it last year. The 10-year treasury was up 4%, gold was up 45%. Why would anyone hold our treasuries? Why would anybody? It's doubled the performance, that being the gold, over the 10-year treasury for the last 25 years. Why would anyone hold any duration financial instrument of the U.S. government when we are as fiscally irresponsible as we are and have signaled to the world, screw austerity, we're just going to print? Where in the 6 weeks we were shut down, we added $600 billion to the debt. In seconds, 20,000+ years ago. So, I don't know. I think that they at this point realize that it'll be a bigger problem if you see massive layoffs because the system is just gummed up. And so they're going to give in, and I think they'll lower rates.
If we step back from the emotion, from the headlines, from the noise coming out of the Federal Reserve, the Treasury, and the business networks trying their hardest to pretend everything is normal, what we're watching right now in the precious metals markets is nothing short of structural breakdown. And I'm not talking about the kind of breakdown gold bugs have predicted every year for 40 years. I'm talking about a real, observable fracture in the West's ability to maintain the illusion of infinite liquidity in gold and silver. When the derivative system begins to lose trust, when delivery mechanisms break down, when exchanges halt trading at the exact moment massive delivery requests hit the screen, you're not looking at volatility, you're looking at loss of control. People forget a basic truth. The COMEX was never designed to be a source of physical metal. It was designed to be a price-setting mechanism built on leverage, on paper promises, on the assumption that almost no one would ever stand for delivery. And that assumption worked for decades, until 2020, when a shift began that has only accelerated. What we are seeing today is the culmination of that shift. A world that no longer trusts the West paper system to deliver real metal, and a group of well-funded, well-informed players, far bigger than any retail crowd, who are draining the system by standing for delivery aggressively, consistently, and without hesitation. We just witnessed something extraordinary. In the first 2 days of the December delivery cycle, the COMEX saw 23,970 gold contracts stand for delivery. That's 2.397 million ounces of gold. In silver, we saw 8,305 contracts, or 41.5 million ounces, stand for delivery. This is not normal volume. This is a run on the bank in slow motion. Then you add the kicker. November, traditionally not a major delivery month, still saw nearly 20 million ounces of silver delivered and 1.2 million ounces of gold. These are unprecedented flows, and they are coming at the same time that registered inventories on both the COMEX and LBMA have been quietly, steadily evaporating. This is where it gets interesting. These flows are happening without speculative participation. Open interest is incredibly low. The hot money, the hedge funds, the momentum chasers, they're not here. In fact, the open interest in gold is sitting near levels historically associated with oversold conditions. So if gold and silver are rising, and they are rising on thin open interest, who's driving the market? It's not leverage, and it's not the retail crowd. It's the most well-funded entities in the world: sovereign actors, state-aligned buyers, industrial entities securing long-term supply, and a handful of obscenely large private actors. And this brings us to the $2 billion question, literally. Someone stood for delivery in silver to the tune of $2 billion. A single entity, or a coordinated set of them, demanded tens of millions of ounces from the COMEX. And the rumor, originating in Shanghai, not Chicago or London, is that this request came from Asia. Whether it's a sovereign wealth fund, a state-aligned industrial conglomerate, a strategic reserve, or a private Chinese billionaire with a patriotism streak, the message is the same. The world's largest liquidity centers for precious metals are being rated for real metal, not paper exposure. And what happened at the exact moment this massive delivery request hit the system? The COMEX suffered a server cooling failure, an overheating issue at 1 a.m. Chicago time in December in a data center that has redundant cooling systems by design. And somehow only the precious metal servers, not the FX, not the bond futures, not the equity futures, needed to be shut down for nearly 12 hours. You don't need to be a conspiracy theorist to raise an eyebrow. You just need to understand how critical exchanges treat uptime. A CME metals outage during the most pivotal delivery event of the year is not randomness. It's desperation, whether technical or political. And this isn't the only delivery system showing strain. The LBMA recently moved from T+1 to T+8 weeks for bar transfers due to truck shortages and manpower constraints in London. That's the equivalent of your bank saying, yes, you own that money in your checking account, but you can pick it up in 2 months. If the gold market were a bank, that is exactly what a bank run looks like.
You shouldn't even think about it until it's 50 to 1, in my opinion. It's coming out of the ground at 7 to 1. It's averaged about 45 to 1 for the last 100 years, price-wise, and that was with a 16 to 1 geologic ratio. Now it's 7 to 1. It's disappearing, and the demand for it is out of control, with the U.S. government just classifying it a critical mineral. China doing the same thing and massively reducing exports. I would say to you that is definitely not the time to do. 5,000 years, the geologic and price ratio was 16 to 1. Go back to the Romans, it was 12 to 1. It's been 16 to 1. And Sir Isaac Newton figured out the amount of gold and silver for the currency, the UK, I don't know how many hundreds of years ago, 16 to 1. Now the geologic ratio, because silver is found in nature in a form called epithermal, like your skin is epidermis right near the surface, the big deposits have been exploited a long time ago. And so the geologic ratio is 7 to 1. Mann's ratio, because of gold's role as money and silver in industry and suppression through the military industrial complex, whatever way you want to look at it, which is undebatable as far as I'm concerned, but has been roughly 45 to 1. The further away you get from historical averages, the greater the magneticism that pulls you back. I live in Delray Beach, Florida, on a golf course. If I spent 50 years in Minnesota. I have two snowmobiles in my sister's garage in Minnesota. I used to love to go snowmobiling every year, and I still do, but haven't gone for a few years. If I woke up to 4 feet of snow on the first tee box here, I wouldn't call my sister and say, ship me my snowmobile, because I would know it's an anomaly. Now, price anomalies can stay irrational longer than you can stay solvent. That's an old market truism. But anomalies typically do resolve. Mother Nature gets her way. And this one will too. It just is taking longer. But if you realize it comes out of the ground at 7 to 1 and it's averaged roughly 45 to 1, then why wait? Why not wait until it gets to that point? You're talking, 50% less than you could otherwise get if it just gets to its average. And just getting to its average is a double. And that average is almost 150 years long. And it would still be 6 times higher than it's coming out of the ground at 7 to 1.
Do you see Warren Buffett potentially going into the gold and silver market and using some of those funds to buy in? Or do you think he's got another strategy altogether?
I really don't know what he thinks. I mean, he's a very old man. I think he's thinking about his legacy more than anything. I wouldn't be surprised if he owns a good bunch of it himself. Just says the opposite. The fact he is in cash the way that he is, the fact that gold is up 70% and the S&P is up 16% amidst the greatest tech boom in history with the AI, and the insiders are selling $2 billion a week since June. It's not just Buffett. You got sold $7 billion in Amazon. You got insiders and board members of NVIDIA dumping a couple billion in stocks. You got Zuckerberg dumping, Jamie Dimon dumping, and the institutionals dumping, as the public is all in on stocks. The largest allocation to stocks they've ever had, 45% or so of the market is by retail investors. The largest exposure to options, which is speculation, and the largest exposure to margin debt, which is leverage, at all time, 1.5 trillion in margin debt, as the insiders are selling. And who the hell is buying billions and billions and billions and billions worth of gold and silver since November? Every month, we're net importers of gold for the first time in my career, and other than brief episodes, maybe ever. So who's buying all this gold? People at that level don't do things just for the hell of it. They know what's coming. At the same time, they're quietly exiting the equity markets as the public's all in.
When you consider what comes next, the most important point to understand is that Western price discovery for precious metals is losing legitimacy. Markets only function when trust is intact, and the West's entire metals pricing framework, from COMEX futures to LBMA spot, is built on trust. Trust that contracts will settle, trust that metal exists, trust that exchanges will remain open and functional, trust that bars can be moved when purchased. Every failure, every glitch, every delay erodes that trust. And once trust in a price-setting mechanism collapses, the mechanism itself collapses. Take the so-called cooling failure at the CME. People forget this wasn't a 15-minute outage during heavy traffic. This was a 12-hour shutdown during one of the lowest volume windows of the entire week, and the only server cluster affected was precious metals. That defies logic. It defies the engineering standards of any Tier 3 data center, let alone the CME's mission-critical infrastructure. If this happened during a routine trading day, you might chalk it up to bad luck. But it happened on the exact night silver blew through $54 in Asia, and on the exact night a massive delivery request, hundreds of millions of dollars, hit the December contract. That is not coincidence. And whether the system failed on its own or was intentionally paused to prevent a cascade, the result is the same. People no longer believe that the price on the screen is a reflection of a free market. And when the perception of free markets evaporates, capital migrates to markets that are perceived as fair, even if they are not politically aligned with the West. This is why Shanghai's influence is growing. In Shanghai, if you buy a silver contract, it must be backed by a pre-existing, serial-numbered bar from an approved refinery. No rehypothecation, no paper overhang, no synthetic exposure. You pay your money, you get your metal. That is why premiums in Shanghai have been consistently higher than in New York or London. The market is telling you where real price discovery lives. And as confidence in COMEX and LBMA weakens, Shanghai becomes the gravitational center of a new global pricing regime. This shift doesn't happen overnight, but it accelerates when the old system shows cracks. And right now, every crack you could imagine is widening. We have the LBMA announcing delays of 8 weeks for bar transfers. We have COMEX inventories, registered metal, being bled dry, with some months seeing 50, 60, even 80 million ounces taken off the books. We have backwardation signaling shortage. We have spreads blowing out between spot and futures. These are not normal conditions for a healthy market. And then you have sovereign behavior. Sovereigns are telegraphing their intentions in plain sight. China's export controls, India allowing silver as collateral, the US officially reclassifying silver as a critical mineral. These are not symbolic acts. These are strategic positioning signals for a world where precious metals, particularly silver, become essential for economic security. This is why I keep telling people, what's happening in silver is not primarily speculative. It is structural, it is industrial, it is sovereign. If retail joined in, prices would already be multiples of where they are. But the irony is that retail isn't coming. Retail is levered to the eyeballs in equities. Retail is seduced by AI narratives. Retail is chasing call options on companies that insiders are quietly dumping. Retail doesn't understand what's happening under the surface. And that's exactly why silver can still trade at levels that don't reflect the true strain in the system. The general public simply doesn't see it yet. This is also why the shorts are cornered. It's one thing to short silver when the only people who take delivery are a handful of coin dealers and industrial buyers. It's another thing entirely when sovereign entities stand for delivery on tens of millions of ounces at once. When the people short the contracts don't have the metal, and the people long the contracts refuse cash settlement. The system has two options: default or restructure the pricing mechanism. A data center cooling outage is not a restructuring, it's a pause button. But you can't hold the pause button forever. Consider the analogy I mentioned earlier. For decades, the West treated precious metals like a cardboard box with a picture of a cookie on it. They traded the picture, they leveraged the picture, they wrote derivatives on the picture. But the buyers today don't want the box. They want the cookies. And when the system opens the box and discovers that half the cookies were lent out, half were leased, half were swapped, and half were never there at all, you get a realignment. The Western pricing system is being forced to confront its physical shortfall. This brings us to what the Federal Reserve is doing. The Fed is cornered. They have a deeply inverted yield curve, structural deficits, exploding treasury issuance, and a bond market that no longer believes in their inflation narrative. They cannot fight inflation without detonating the economy. They cannot stimulate the economy without detonating the dollar. So they are choosing the politically convenient option: tolerate inflation, claim progress, and quietly reflate the system through lower rates and balance sheet support. People celebrate 25 basis points as if that changes the trajectory of a $34 trillion debt system that grows by hundreds of billions in weeks. It doesn't. The Fed is not fighting inflation. The Fed is surrendering to it. The Bureau of Labor Statistics manipulates inflation through hedonic adjustments, substituting steak for hamburger, hamburger for beans, coffee for tea, until they can present an index that flatters the narrative. But the reality is obvious. Inflation is not 3%. It is closer to double digits if measured honestly. And what happens when a central bank surrenders to inflation? Hard assets outperform financial assets. That is exactly what we're seeing. The 10-year Treasury returned roughly 4% last year. Gold returned over 45%. In the last quarter century, gold has outperformed Treasury returns by a factor of 2. Why would any rational actor hold duration government paper in a country running multi-trillion-dollar deficits, monetizing debt, and losing foreign buyers? They wouldn't, and sovereign flows confirm it. Central banks around the world are dumping treasuries and adding gold. They are openly signaling that the dollar is losing trust. This is the environment in which silver is exploding. Silver is the most undervalued monetary metal in the world. If gold merely moves sideways, silver's gold ratio implies dramatic upside. If silver reverts to historical ratios, 40 to 1, 16 to 1, even 10 to 1 under extreme stress, you are talking about levels of repricing that seem absurd until you compare them to the repricing happening in real time across energy markets, industrial metals, and geopolitical commodities. People ask me, is this a blow-off top? My answer is no. Blow-off tops are driven by speculation, leverage, and momentum. What we are witnessing is driven by physical demand, sovereign uptake, industrial shortage, and structural deterioration in Western price discovery. That's not a blow-off. That's a realignment. But we must also acknowledge that volatility will increase. The system doesn't collapse cleanly. There will be days where silver drops 50 cents, $1, $2. There will be engineered sell-offs. There will be margin trigger cascades. But the pattern, aggressive dips immediately bought by deep-pocketed players, is the hallmark of a supply-constrained market trying to reprice itself against resistance.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.